There we go. Welcome to, what are we, week 7? Uh, so this evening we're talking about forecasting. Uh, at the end of next week, you're giving me your analysis of the earnings conference call. And I was just saying before I started the recording here that that's something that will be useful when you're thinking about doing the forecasting for your organization, for your major project. Um, what I thought I would do, kind of in the interest of time, I'm going to jump straight to what I've got as slide 14. And what I've got on 14's that appearing for you? Is that all okay? Okay. Um, Let me just drag this window over here so I can kind of see you lot. Uh, I thought I'd just sort of speak about generally um, what's what's a systematic process and why does this kind of work? Then I can show you um, how I've implemented that with a set of JB Hi-Fi forecasts. Um, so hopefully for most of your organizations and most of the businesses that you're likely to be analyzing, the most sensible first line item to forecast is next year's sales or next year's revenue, because that's kind of what everyone thinks about. So that's what the CEO is thinking about, what the CFO is thinking about, what all the analysts are thinking about, what the bankers are thinking about, all of that. So first thing we think about is what's next year's sales number likely to be? And we can kind of work backwards and think about, okay, so how do we get that? And there are a number of ways of getting that. And we'll talk about sort of if that's a combination of firm specific, industry, and macro as going to influence that. And the way you might build up a sales forecast is going to vary firm by firm and industry by industry. But coming up with that number is kind of like your starting point. Then we want to think about it in two ways, I guess. It's if we want to think about the income statement side of things, so the left-hand side of that figure that I've got up, we're really thinking about, I've thought about how sales are likely to vary from this year to next year, or from the recent trend to next year. Next thing I want to think about is, so how will margins be changed? So, or to what extent will margins change is really the way you want to think about that. So are we getting more sales because we're cutting prices and margins are compressing? Are we getting more sales because we're increasing prices because the customer demand is there and we can get higher margins? Or are we getting more sales because we have bought an additional business, like JB Hi-Fi has just bought a kind of a Victorian-based kind of fancy homewares business. So part of their additional sales will come from that acquisition. So there are a number of ways of, and at the moment, the margins on that business are low. So the overall margins for JB Hi-Fi may well go down. So the key here is thinking about, okay, I'm thinking about how I get next year's sales. Then I think about what are the margins going to be on those sales? And I guess what I'm really talking about here is we could be thinking about this in terms of gross margins, then other operating expenses to get our operating profit, so net operating profit. Then we'll think about the way in which it's financed. And then we can think about the tax rate, and that will give us a kind of a pro forma income statement. So the kind of the line items will be some form of margins, be it operating profit or other profit margin as appropriate for your business, then interest, then tax gets you income statement. On the other side, we've got a balance sheet. So we're thinking about, I've thought about what my sales figure will be next year by forecasting turnover. So that's asset turnover. So asset turnover, we were thinking about last week and the week before as sales divided by assets. And we can break that up into sales divided by operating assets, sales divided by short-term operating assets, so working capital, sales divided by net long-term operating assets. So we don't have to have just one turnover ratio. We can get a couple of turnover ratios. What we're really saying here is for the level of sales that I've forecast, what investment in assets does my business need? That's really what that question's saying. So, in other words, what level of assets am I going to need to generate that sales? Yeah, and that's what we mean by turnover. So for each, and one way of thinking about that is for each additional dollar of sales, what level of additional assets do I need? Now, what that gets you thinking about is, well, what is the nature of the business? Is it if I'm selling inventory, I need more inventory. And if I'm selling more because I'm opening up stores, I'll need more stores. In other words, I'm forecasting if turnover tends to be relatively stable, and that's what we saw last week with kind of those mean reverting charts, then you want to think about, okay, if turnover's stable, that means the net operating assets is going to change kind of in the same proportion that your sales are going to change. It might be that you're dealing with a software business, well, let's say like a social media app or a software as a service business, where you don't need to make any additional capital investment to generate more sales. So you could plausibly be forecasting an increase in turnover. So you could have increased sales on the same asset base. But what this process is getting you to think about is, well, what's my firm going to need to do to generate those sales? Um, so we've got the what's the level of operating assets that my business needs? I can then think about how are they going to be financed? And that's what we mean by leverage. So once we've thought about how they're going to be financed, and by that I really mean, is it debt or equity, or some combination, that then lets me know the kind of the operating assets, that lets me know the split between kind of net debt and equity. Um, the level of debt obviously feeds into the income statement by interest. The level of assets that we've got feeds into the income statement by depreciation. So there's obviously an interplay between the income statement and the balance sheet. But as a kind of just a way of getting you to think about things, is that summary making sense? Sales in the first instance, how are we, and basically sales, and how are we going to get there, both in terms of margins and in terms of the assets in place to generate those sales. That all okay? Yep. Thanks, Dan. Okay, if we're happy enough with that. Oh, that's a raised hand. Yeah, go for it.
Sorry, I wasn't raised the
Yeah.
hand. So just quickly on that, I mean, unless you know through an earnings call or something, the CEO or the CFO said, look, yeah, next year we're going to expand um, the business with 25%. Is it fair to say, looking at the backwards trend over the last 5 or 10 years, and say, well, this is what happened over the last 5 or 10 years. So let's project that forward for the next 2 or 3 years. Unless you've got any other credible information to say, well, this company is going to do this.
Yeah, that's normally a good way of thinking about it. And I guess is that terms in terms of thinking about the turnover particularly, or more generally the sales?
I think both.
Yeah.
Yeah.
So if we're thinking about sales, let me go back. So um, I guess if we're forecasting about sales, and this is not JB Hi-Fi specific, it's going to be a combination, as I said, of three things. It's to what extent does changes in the macroeconomic environment impact demand for your product? Now that's kind of number one. So, and that could be is GDP a factor? If the Reserve Bank jacks up interest rates another 50 basis points or drops interest rates 50 basis points, is that going to matter? Um, uh, is there likely to be regulatory changes in the overall economy as opposed to industry specific? So what we're thinking about here is, what are the long-term drivers of demand for the things that your firm is doing, is really what that focus is. And I guess we can kind of think of then about, we've got, so macro, Then we've got industry. So to what extent, to what extent are there industry pressure? Is there likely to be more competition? Is there likely to be less competition? If we're dealing with, say, natural resources, to what extent is China likely to be a factor, or some other major purchaser within the industry? To what extent are competitors in South America or somewhere else likely to change their strategies? And then you think about, what is it that the firm has said? JB Hi-Fi, for example, they, in their investor presentation that they put out each year, they tell you about, here are the net number of stores that we have opened and closed over the course of the year. And they'll often talk about, they made statements in the earnings announcement call about how many stores they anticipate opening in FY25. And so there's various places where you can get that information. As I said, the investor presentation is always a good one to look at. The conference call itself was good, because that type of CapEx decision often comes up in the analyst Q&A. So that's kind of the things that you want to think about in terms of what are the influences. What do we know overall about the way in which sales growth operates? We saw that mean reverting pattern for profitability that kind of looks like this chart that I've got here. And so that says that really high and really low levels of performance tend not to persist forever. Again, on average, over time for large samples. The sales growth pattern is even more pronounced. So what that tells us is that it's really hard to maintain sales growth that is really high. These are averages, so there are firms there'll be variation at the top and the bottom of that, but we can see that on average things really quickly come back towards some sort of mean pattern there. So the long-term averages tend to be, tend not to be extreme either way. And so that, again, you don't have to forecast this exact pattern, but the reason that I can keep showing you this is in the back of your mind as, look, here is what is typical. If I'm forecasting something that's not typical, what's the story that backs that up is really what the key is. And you say, look, my firm is about to go on an acquisition binge because the CEO told me they were going to do that, and they're going to buy a business a year for the next 5 years, in which case sales growth is going to go up and won't look like this pattern. But at least you've got a story that is plausible to back that up. So it's thinking about, what are the drivers of demand for the product or service, lay it in with how we know things behave over time. But obviously, and the other side of that is, look, our business has said it's going to hive off a major division, so sales decline is likely to be occurring for at least that year, and then you want to think about what happens after that. Is that kind of making some sense in terms of how you think about that? So how do sales typically behave over time? Really dramatic mean reverting pattern is what we see there. As I said, the profitability ratio. So this is kind of both return on equity, return on operating assets, which is really similar to what we saw last week that I showed you about return on invested capital. So operating ROA and return on invested capital are identical if we assume that operating assets and invested capital are kind of measured the same way. So I said there can be some differences in where you put your tax assets and tax liability, but it's the same underlying kind of construct that we're dealing with. So operating ROA is going to be exhibits this mean reverting pattern. Return on equity exhibits this mean reverting pattern. Again, and this is a point that I'll kind of stress next week when we're looking at our valuation. The difference between the two is often a case of, from whose perspective are we interested? If we're looking at the perspective of the shareholders only, return on equity makes sense as our measure. if we're looking at the perspective of all capital providers, a return on invested capital or an operating ROA kind of makes more sense because it quarantines the effects of the way in which the business has been financed. What we'll then think about in terms of our valuation is what's an appropriate benchmark for each of those measures. And that's where we start thinking about if the ROE or the ROIC is above the appropriate kind of risk benchmark, then you're creating value for either your shareholders or financiers. And so that's when we compare things like ROE and the cost of equity capital, or return on invested capital and weighted average cost of capital. Again, we'll look at that when we're building up our valuation models next week. So that's what we've got in terms of the return on equity, return on assets measures. Here's on the right-hand side, here's our asset turnover, or more precisely, it's our operating asset turnover. So what we see here is that tends to remain stable over time. Yeah, so I said last week, that makes sense. If you're a capital intensive business with a lot of assets on the balance sheet this year, chances are you'll be a capital intensive business with a lot of assets on your balance sheet next year. Or if you're a retailer that is trying to roll your inventory over all the time and you've got really high turnover this year, it's likely that that's what you'll be next year, unless you've got a dramatic change in overall strategy. So that's why turnover tends to remain far more stable than most of the other ratios. But as I said, there are exceptions, and the particular ones to be thinking about are a lot of our digital service, so our software as a service type firms, or our anything where you've effectively got zero marginal cost of selling another unit. So if you produce it once, then sell it forever, that's where you can get increasing asset turnover over time. That making sense? That kind of, again, think about this as in the back of your mind, this is just giving you a sense of what is typical or what is plausible. And if you're forecasting something different for your firm, as long as you've got a story that you're comfortable with and that kind of makes economic sense, yeah, that's fine. Another reason why this kind of forecasting framework or summary is useful is that if you're forecasting out the income statement and the balance sheet, hopefully it means that you avoid some of the common traps in forecasting where you might just be forecasting, say, earnings, doing a multiple of earnings, and not thinking about the investment that's needed in generating those earnings. And so that way, often I see forecasts where you've got effectively an implied increasing return on equity forever because people haven't forecast the cost involved in growing the business that are usually non-zero. What I might do now, let me just jump and I'll show you how this works for the JB Hi-Fi spreadsheet, and just show you, I guess, a couple of things that you want to be aware of when you're looking at that spreadsheet and the extent to which you're going to be using that as a base point. Because there are one or two little, I didn't want, let me kill that one. Let me go there. This should work, hopefully. Okay, let me just make this a little bit larger so we can see. Okay, so what have I done for JB Hi-Fi? I've simply followed the way that the business is outlined as segments. And so I've broken things down into JB Hi-Fi Australia, JB Hi-Fi New Zealand, and the Good Guys. And the reason I've done that is that's the way the business thinks about things. And I know that because that's the way they kind of structure their investor presentations. I know it's the way they do their segment analysis in their annual report. And it's the way they talk about it in the earnings announcement. And so it makes sense to think about this. And because it's a retailer, it's a combination of physical stores and, I guess, increasingly online sales. And so what I'm thinking about is what's the number of stores? What level of sales are they going to generate from each stores? What level of online sales are they going to be able to generate for each of these three components? And so that's the way I've kind of worked out the JB Hi-Fi forecast. Different industries will have different things that will be driving the sales revenue. Um, it's going to be some combination of, I guess, price and quantity is what you want to be thinking about. But you set it up in a way that makes sense for your business. So what are the main things that they're selling, or main services that they're providing? How's that likely to change? Where do I get, for example, so these numbers, historically I get from the investor presentation pack. They give me this again in the investor presentation pack, so I know what these numbers are. I know that they're for, like, where do I get this number from? This two for the next year's. Let me again. I'll just make that slightly larger. Where does this two come from? That's from what the CEO said that they were going to do. The rest of the numbers is just, okay, they seem to be doing around one a year. They're not really focusing on store growth, so I'll just forecast one a year. That will give me the kind of end of year stores, and from that I can work out the average number of stores open over the year. Look, this is not going to make too much of a difference for JB Hi-Fi, but if you're growing rapidly or shrinking rapidly, then the difference between the number of stores at year end and average is going to be important. Again, online is important for JB Hi-Fi and also Good Guys. And you can kind of see the COVID effect here. So 56, 90, 52. And then unsurprisingly, we kind of had negative online sales growth when COVID ended in 2023 and people wanted to go back in store. Kind of makes it difficult to work out exactly, okay, so we've had 2.8, yeah, 30. So it's, so I said, these are the numbers that it's hard for me to work out exactly what they're going to be. And where it's hard is something with you in a second, Tim, is and that will become important when we think about doing some sensitivity analysis. So what you want to do in your project is flag, look, this is where I have some uncertainty in the forecast. So don't shy away from that. You want to let the reader know. Yeah, Tim, go ahead.
Yeah, is that maybe where you can start then looking at it like a macro, or when I say macro Australia wide, and looking something from the Bureau of Statistics where they say, look here, they expect online sales for electronic goods to grow at 5% a year for the next 5 years, and then
Yep.
yep.
Yeah, and so, and yeah, and that's exactly what you'd be doing. So yeah, do I have any industry specific information? Is JB Hi-Fi doing something or something different with their online sales? As it turns out, they've got this JB Hi-Fi marketplace that they're using, so that might mean that there's a slight variation from the industry. And what we want to be really checking is that what we've got kind of in our final year, is that number making sense? Again, I'm going to talk more about that next week, because that becomes our terminal. When we kind of add all of this up, we end up with kind of a terminal value or final year of our forecasting process sales growth. Now, that's really important in driving our assessment of overall value. So you want that to be a kind of an economically plausible number. I guess while I'm kind of looking at this, I've got 5 years here. One of the things you need to make a call on is, what is the appropriate forecasting window? The reason why I've chosen, what we're aiming for with our forecasting window is, at the end of the way our valuation models will work, once we get to this terminal year, we're effectively assuming that everything that we're forecasting after that terminal year stays the same. I'll jump back to this later on. So sales growth, margins, turnovers, everything remains constant. So when we're thinking about this forecasting window, you want to be able to say, look, this is the period of time over which I think the firm's going to approach steady state. For a heavily regulated utilities where there's not likely to be much change, you could make a plausible claim that, look, I really only need 3 years worth of forecast and that's going to be fine. For something that's going through a lot of change at the moment, you might even go out 7, 8, 10 years before you think you can be comfortable at getting steady state. The trade-off is, going out too far, you're becoming increasingly uncertain about what's going to happen. So you kind of want to play that off. Because we're valuing equity here and we're assuming things go out forever, the other consideration that often comes up that's not relevant is if I'm valuing a project that has a specific life. So let's say I'm doing a mining project where I've got a 20-year lease. I'll model out the full 20 years. So if I've got a fixed time period for the project, I'll model out that whole period. So again, you adapt this to the circumstances in which you find yourself. 5 years, I think, is plausible for a business like JB Hi-Fi because I think the effects of COVID will have washed out by there. One difficulty here is that they've kind of bought a new store, and I don't really know, and no one quite knows how much they're able to grow it and the extent to which that's going to affect margins. The other reason why 5 years is plausible, if we think about those charts that I showed you about the mean reverting pattern, most of kind of the action takes place within 5 years. So 5 years seems to be a reasonable amount of time to get there. As I said, it's the trade-off between what we think is a plausible forecast and what we know happens long term. Margarita.
When you calculated that the store openings and you assumed that as the revenue growth driver, did you then also figured out how much increase in sales was that extra store in percentage of sales?
Yeah, so what I've done here is if we're, say, just looking at, let's just look at JB Hi-Fi Australia, where they've told me they're going to open 2 new stores. So how that feeds into my forecast, if I scroll down, I've said, look, I've got a couple of things. I've got what's their revenue per store that they're able to generate. And so I need to think about what's the product mix, what's the pricing strategy. I'm not inflation adjusting, so this is just going to be like raw dollars. So to what extent is inflation going to make this higher generally? So I'm assuming that we won't have a large uptick in revenue per store. I've then said I will get this physical store sales is going to come from the average number of stores that I'm forecasting by the number of stores. Now, what I'm assuming here is that if they're opening a new store, that the sales are going to be able to come on at the same rate as the existing stores. For a business that's well established, that know what they're doing in rolling out new stores, that could be a pretty reasonable assumption. For some businesses, we find that there could be a spike in revenue, then it declines. Remember when Krispy Kreme first opened up? Whenever they open a new store, massive spike in sales in kind of the first year or two, and then it tapers off. Other stores, it takes time to build up. So what I've assumed here is that because this 2 will be a net 2, so they'll close 1 or 2, open up 3 or 4. I've assumed that the revenue per store stays the same over the suite of those physical stores. Is that answering the question that you got? Yeah. So for JB Hi-Fi Australia, I've calculated the physical store sales by the average number of stores by the revenue per store. So I'm thinking about how that changes. For the online sales, if we're looking at that, I've taken last year's online sales and I've multiplied that by this G11 is the extent to which I think online sales are going to grow. And so that's kind of, yeah, so it's again, and the other way I could do this is just trying to separate. Yeah, so the online sales is not driven by the number of stores. Yeah, that's kind of so the change in the number of stores won't directly affect the online sales. Yeah, so that's what I've done for both JB Hi-Fi, Australia, New Zealand, also the Good Guys. Again, different ways of putting this together for different organizations. And then the other kind of thing that I had to watch out for here is that all of the segment numbers that are reported in the JB Hi-Fi presentations are in New Zealand dollars. So I kind of had to do a look, what's a currency conversion here? They report the total revenue in the financial statements, but in the investor presentation where they give us a lot of this detail and the online sales growth and so on, that's all in NZD. And so again, just be careful if we're dealing with multiple currencies. what I end up with, and here I also need to think about, okay, they've bought this new organization, and I can't spell remaining, but I'll change that. So they've got 75% of it, and I need to sort of work out what I think they're. So I think this is probably, they'll be able to grow things at more than 10% per year because they've got experience in kind of making acquisitions now and turning them around. So that's probably conservative. What I would kind of want to look at then is, so my overall revenue growth that I'm getting. So I've got 6, 6, 2, 4, 1, and 4, just by way of them. The one that I'm probably most, I guess the one that's going to be most important for driving value is that one that I've got highlighted now as the that 4.2. And so I want to kind of think carefully about, okay, do I think the JB Hi-Fi can drive sales growth forever at 4%? And what would be a sensible benchmark? So I think a sensible benchmark is probably, if I'm thinking about, okay, it's a combination of number of people in the market, so population, their capacity to spend. I think a lot of that's captured by GDP growth. So I think that GDP growth is a reasonable proxy, and I'm betting here that they can do a little bit better than GDP growth, because I think long-term GDP growth in Australia and New Zealand is not going to be 4.2%. Probably 2.5% might be an ambitious bet at this stage. So I haven't plugged these numbers into a valuation model yet, so I don't know what this is going to give me. That's the number that I'm probably most worried about, and that I'll kind of subject that number to a fair bit of sensitivity analysis. But yeah, so you can build up your sales forecast in a way that's appropriate for your business. If you had a look through this one before, any other questions on this particular tab? If not, then I'll kind of jump to the forecast tab and I'll show you what's going on there. All good? Okay. So I've done this in kind of I've got my main forecasting assumptions, or my only forecasting assumptions. I've got a condensed balance sheet and I've got a condensed income statement. So this is all I need to generate my forecasts of both equity or enterprise value. So I've in effect collapsed everything into these forecasts. So really what I want, or what I'm going to be forecasting, these key factors. I want to know sales growth. I want to know the margins, the operating profit. I've got here working capital and long-term assets to sales. This is the inverse of turnover. I showed you on that forecasting summary slide asset turnover. This is 1 divided by asset turnover. And I'll tell you why I've got it like this. What this is saying, so the 2.2%, let's say actually it probably makes more sense to think about this number. So I'm saying 17.6% long-term assets divided by sales. What that tells me is that for each additional dollar of sales, JB Hi-Fi needs to spend 17.5 cents. Now I'll say that again. For each additional dollar of sales, JB Hi-Fi will need to spend 17.5 cents in its long-term assets to generate that. So that's what that means. This working capital requirement means that for each additional dollar of sales, they'll need an additional 2 cents worth of working capital. Okay, because there's more inventory, there's more suppliers, there's more customers, and so the working capital, there will be a working capital requirement. For this sort of business, it's the long-term operating assets that's kind of obviously more important in determining the size of the business. So that's what's going on. That's why I've set that ratio up like that, because it just gives you, I think, it's easy for me to think about the business in those terms than think about a sales divided by long-term assets is going to be 2.34. That kind of means less to me. So that's why I've taken the inverse there. The other thing that I've done here, which I kind of haven't explained why, is I've taken start of year values. Now, when we're looking at that performance analysis, I was saying, look, if we've got balance sheet items, we will normally analyze performance over average value. So why have I taken the start of year value here? The reason I've done that is that when we get to the valuation side of things, the valuations normally say, look, we want to sort of do a valuation as at a date, and we need the opening or the start of year balance sheet for that kind of valuation, be it a discounted cash flow or a discounted earnings. So our main valuation models are based off what was the latest reported balance sheet. So that's why I've kind of done the balance sheet ratios this way. So start of year, start of year. Now, the start of year balance sheet, so the start of 2025 is by definition the same as the balance sheet at the end of 2024. So if we think about what the balance sheet is, it's a snapshot at a point in time. So what I'm forecasting, so these numbers are all, this is actual, based off the actual balance sheet, as is this extra 2025 column here for the balance sheet. So again, the start of 2025 is the end of 2024. So that's the reported balance sheet from 2024. Is that logic making sense? Yeah. Thumbs up, thumbs down.
Yep.
Yeah, all good. Yeah, again, because this is just worth, because otherwise, if you kind of look at this later, you go, oh, hang on, why are you using start of year? So the things that I need to forecast, sales growth, margins, turnover, financing costs, and capital structure. If I forecast those items, I'm going to get enough to forecast free cash flows or an appropriate earnings measure. And it won't matter whether I want to think about things from a shareholder's perspective or the enterprise perspective. I get enough out of this. So what we're doing here is we're kind of we're collapsing the forecasting down to key variables. And so we don't need to forecast every single line item on the income statement. We don't need to forecast every single line item on the balance sheet. So that was part of the point of doing that, collapsing everything in our ratio analysis into those categories, so that so the less categories I think about, the better my forecast is going to be. What we do know is that the more complex we make our forecasting models, the less accurate it's likely to be. So keeping things as simple as possible, there's going to be some benefits there. So what have I got? I've got my balance sheet. I've pushed around in the same way that I have this simply reflecting this balance sheet here, this that I had when I separated things out into the operating and financing components. So that should be matching up in my forecast. So 1898 was the number for the net operating assets and net capital. These two numbers always have to equal each other. So row 15 and row 18 have to be the same, because it's just a way, it's rearranging the balance sheet. The income statement, again, I'm forecasting sales, I'm forecasting operating profit, and I'm forecasting interest expense, both after tax. And that gets me my net profit after tax. Again, these are all historical. So once I've got my sales growth numbers, once I've got my sales growth, then, and part of this, so why have I got 6.1, which seems relatively high? That's because I've got that acquisition of the new business that's going to kick. We've got an extra couple of $100 million worth of sales coming from that. So that's why 2025 is higher than I've got for 2026 and so on. Once I've got next year's sales growth, I can then forecast next year's sales. And if I've got next year's margins, I can forecast operating profit after tax. So sales drives this sales line. It also then means that I can forecast once I've got sales, I can kind of complete there. And I've got these two cells are highlighted in a slightly different way. This is saying for each dollar of long-term assets, I'm going to need, sorry, for each dollar of sales, I need 17.6 cents of long-term assets. So in other words, I've got just under $10 billion worth of sales. So I've got $1.5 billion worth of long-term assets. So these numbers are all based off what I observe historically. So these are actuals. These two numbers that I've got here in the green, what's going on here is that these are numbers where the balance sheet number I already have. So the start of year operating working capital and the start of year net long-term assets already exist. That's end of last year. But the sales is part of my forecast for this year. So that's why I've kind of highlighted those as it half is historical, half is forecast. So once I've got my sales forecast, I can generate this and saying, look, that this number is going to be, it'll be a combination of the working capital that we had at the end of last year relative to the sales that I'm forecasting. And same for the the long-term operating assets. The other forecasting items that I've got, I want to think about their after-tax borrowing cost. And we kind of know that that was kind of, low during sort of the 2021, 22, then started shooting up. I'm not an interest rate forecaster, so I don't know when RBA is going to change, whether it's going to go up or down. What I will do then is say, look, it's probably not going to be any lower than 2024. I'll keep it at 5%. And again, one of the things that I would do is say, does it matter if I vary that number from 3% to 8%? Yeah, does it change things that much? And it will turn out that it doesn't change things. But again, all we want to do is say, look, my best bet is the after-tax borrowing cost is probably going to be around or slightly higher than what it is this year. And so some sort of argument like that is what you'd be putting in your project. Capital structure, here we're thinking about of the total capital, how much is debt? And again, be guided by a combination of what has happened historically and what the business is telling you about their capital management. And they say, look, we're going to be borrowing more, or we're going to be paying down debt, or we're not using leverage enough. So again, be guided by what the company tells you there. Once you've got your forecast here, then, so I said, things drive from sales. So sales multiplied by your operating profit margin gets you operating profit. Sales multiplied by your inverted turnover ratios gets you your asset side of the balance sheet. You can then say, based on our net operating assets, your capital structure ratio will determine how much of that is debt. So I've got $1,900 or $1.9 billion worth of operating assets. 18% of that is going to be debt. So 18% of that's going to be the 339 and so on. And so that's what's going on here. So your capital structure forecasts your net debt. That means that the shareholders' equity becomes the difference between the net operating assets and the net debt by construction. So that's just a straight A minus, well, in this case, row 15 minus row 16 is what happens there, because we know that net capital has to balance the net operating assets. And so that's one of the things that you want to check. And once you've got your net debt, the net debt multiplied by the after-tax cost of debt is going to give you that net interest expense after tax. And once you've got net operating profit after tax and your net interest expense after tax, then that's going to be able to give you your net income figure. Any questions on that at this point? All good. Okay, this making sense. Okay, last thing that I'll say about this one is we look back to my forecast. I've forecast 1, 2, 3, 4, 5 years out, but I've got 1, 2, 3, 4, 5, and then I've got a 6th year. Now, the reason that I have a 6th year here has got to do with the way that we will be setting up our valuation models. What you'll notice here is that the 6th year forecasts are the same as the 5th year, and they kind of have to be, otherwise our models fall apart. So this terminal year that I've got at 2030, these numbers have to be the same as what we've got in 2029. What I'm really doing here, and the reason why I need these forecasts, is because I need I've got a start of 2020 or start of 2030 balance sheet will be an end of 2029. And so really 2029 is my final forecasting year, but I want to forecast what the firm looks like at the end of that year. So that's why on the balance sheet side, I'm going to be including this as the end of, so this is the end of 2029 or the start of 2030. And so I'll say that again. My forecasting period is 2025, 6, 7, 8, and 9. But I want to forecast in 2029 two things. I want to forecast what the sales are going to be and what the income is going to be, but I also want to forecast what the capital expenditure is going to be and what the change in working capital is going to be, because that's going to affect my cash flows. So I need the end of 2029 or the start of 2030 balance sheet. So I'm not calculating income for the year, but I do need sales to get that balance sheet. So that's kind of what's going on here with this terminal value. So that's why these two sets of numbers have to be the same. And so what we'll see next week is that this set of income, operating income, equity, and net capital is going to be sufficient to generate the two main types of valuation models that we're going to see: a DCF, a discounted cash flow, and also an earnings-based model. So it will, yeah, it will do both. Okay, so that's what's going on in that spreadsheet. So I said, you don't have to follow this spreadsheet. Often people do. If you're not used to pushing around Excel, people find it a useful starting point. But I just thought it'd be hopefully helpful just to talk you through kind of those little points. And I've tried to highlight most of those in kind of the notes that I've got over here on the right. I've kind of tried to explain where I have got things, and to the extent that that's not clear, why I've got them. I've also, if you had a look through the week's materials, I've got a video that I had from a year or two ago where I was going through this process for the 2024 so you could sort of see row by row and cell by cell how I constructed that. I haven't redone that video because the process is the same. You'll just see that the numbers have been slightly updated here. So I said, so what we'll be able to do is take these numbers and then generate our valuation metrics out of these. What we'll also be thinking about is how are we going to undertake sensitivity analysis, and what are going to be the key things that we're going to be focusing on. So the number, just looking at this, that I'm most, I guess, worried about, that I think could be on the aggressive side, is that sales growth. But growing at 4% forever is kind of difficult. It's doable, but it's kind of difficult. Other industries or other businesses will have kind of different long-term benchmarks that I think are going to be plausible. Again, this will make more sense when you've had a look at next week's material. There is, I guess, an economic constraint, and there's an algebraic constraint on that terminal value sales growth. As I said, the economic constraint is, what do we think is the long-term demand for what we're doing? The algebraic constraint is, when I start working out terminal values, it's going to be a kind of a perpetuity. And a perpetuity is going to be final year cash flow or earnings, depending on what we're working, divided by R minus G. So the cost of capital less the growth. Again, don't worry about this. This will make more sense when you can see the equations next week. But if we think about how do we value a perpetuity, so a stream, a growing stream forever, it's the payment divided by the discount rate less the growth rate. So it's the payment divided by R minus G. So the algebraic constraint is that our terminal year growth rate can't exceed our cost of capital. Now, for most firms, that's a plausible. So what do I think as a plausible kind of cost of equity capital for JB Hi-Fi? Let's just say, I don't know, 10% as a benchmark figure. Do I think that JB Hi-Fi could grow sales forever at 10%? No, it's not economically possible. So that the algebraic constraint turns out to be a reasonable economic constraint in most years. Okay, let me go back and have a look at other issues in forecast. Yeah, Tim, go ahead.
Is that when you say then, well, let's just look at the 5 years or the 3 years or 5 years outlook?
Yeah, look, that can be a useful way of thinking about. If I think let's say I had 12% as the growth rate in year 5, and I didn't think that was a plausible long-term growth rate, so one way of dealing with that is to say, okay, I'm going to extend my forecasting window out an extra couple of years until I think sales growth is at what is both an economically and an algebraically plausible number. Yeah, so that can help guide that. I think I mentioned earlier in the term, in terms of what are plausible macro benchmarks that might be guiding things. And I said, let me just get in a lot of cases, it's just those key numbers that come up at the top of the ABS website. So depending on what your business is doing, it's probably going to be some combination of how many potential purchases have you got out there? So that's population. To what extent are prices changing? To what extent are people able to pay, judging by the weekly earnings? How many people are are under some sort of economic stress in terms of unemployment? Is that kind of rising or declining? And to what extent is is the country's GDP growing? So yeah, 0.2 as a quarterly change is relatively low, and that kind of is implying like a 1% GDP. So the long-term average GDP growth for Australia is kind of it's in between 2 and 3, so around the 2.5%. But that's the sort of thing that you want to think about. Which of these, if any, are likely to be the kind of the key drivers? Now, it may be that you can say to me, well, my company's in the kind of a natural resources industry and it's driven by global commodity prices. In which case you forecast global. I don't expect you to be a global commodity forecast price, but I do expect you to be able to say, here are what the kind of the most credible forecasting bodies are saying. And again, I'll subject that to some sensitivity analysis. So if it's a combination of tonnage of material times forecast price, then I don't expect you to be this kind of the price forecaster, but show me what you think is going to be a credible, what does everyone use as and it could be something like forward contracts, kind of like a forward price. It could be an industry, but it could be you've got banks or consulting firms or as I said, industry organizations that do this sort of forecasting out there. So plenty of different forecasting bodies out there. Margarita.
Did you use industry reports at all to forecast sales for JB Hi-Fi?
I actually didn't know. Um, eh, what would it probably be sensible to do? And yeah, no, the process that I went through, and I probably if I wanted to get kind of more certainty, it would probably make sense for me to go and have a look at some of those industry ones. Um, but no, the reason I didn't is that JB Hi-Fi are relatively transparent about a lot of their forward
Mhm.
plans. So I kind of am relatively confident that we've got that number of stores. That's not bouncing about a lot. Um, they're pretty transparent about what they're going to be doing with their capex. So we know we've made this purchase of the new business. That's some uncertainty feeding it in there. Um, yeah, they're relatively, as I said, they tell us a lot in their investor information. And so I kind of know I need to be thinking about what's the product mix, to what extent that's likely to change. And there, the industry reports might be helpful there. But no, when I was thinking about those, um, where it probably might make more sense for me to incorporate the industry ones less than the sales growth, it might feed more into the margins that I'm going to be forecasting. Because, but even then, JB Hi-Fi do tell us a lot about the cost of business. They tell us a lot about the extent to which there's discounting on the floor or not. They, like we know about, like, is there like wage pressure? If I was looking at an organization that was less transparent with what was happening within the business, then the industry reports and the industry forecast can be a good way of getting, because again, I don't expect you to be expert forecasters in particular industries. I want you to get a sense of what's likely to drive demand. And you've thought about that in the first thing that you submitted to me. What's going to be, I guess, important is this idea of getting a plausible starting point. So what's a reasonable base case? And then what I'm really going to be interested in is you telling me, okay, here's kind of my base case, but I either think the range of potential outcomes around that base case are kind of really narrow or are really broad, and show me some analysis in doing that. And so part of what we'll be looking at next week in the valuation, and we can even kind of have I can show you where some of that is if I haven't put that up already. Um, what we used to do, or what people used to tend to do, is give me, here's the base case, here's the optimistic case, here's the pessimistic case. And that was fine. But with Excel, it's now easier to kind of run, in effect, a simulation. So run a Monte Carlo analysis, sort of simulate 1,000 outcomes where you say, look, here's a plausible variation in sales growth. Here's plausible variation in profit margins. Here's plausible variation in cost of capital. What happens if I kind of roll the dice 1,000 times? Yeah, what sort of, do I end up with a wide variety of outcomes, or is it still very narrow, or is it kind of, the other way that you can use your sensitivity analysis is that sometimes it's not just going to be kind of a normal distribution that you think is a possibility. It might be the case that, look, we've got a new product coming out. It's going to be really important for my business. So there are really two potential outcomes. One, it's going to do really well. The other outcome is that it's going to go really badly. And you can model that, and you can say, look, I don't know what it will be, but here are the two outcomes. If things go well, business could be worth X. If things go badly, it could be close to or near zero. I'm going back a while now, but one example, I can remember a group doing a similar project to this. You remember the BlackBerry? Yeah, a little kind of, the company that owned that was Research in Motion, Canadian company. People were analyzing research in motion. And this is where the iPad had recently come out, and following on from the success of the iPhone. At that stage, all of the kind of let's call it note takers and scribblers in the boardroom were using the BlackBerry because that's what IT said is safe and is secure. The CEO would have their iPhone, and it was at that point in the kind of the product's life cycle where the CEO was saying, hey, the iPhone's really great, make it work with my IT system. Was kind of that's a simplification, but that's what was going on. Research in Motion was about to bring out their version of the iPad. And so the kind of the forecasting dilemma was, if this goes well, Research in Motion can do really well because we've got our iPad competitor. People will still keep using the BlackBerry. We can go on. If it doesn't work well, then Apple's going to start taking over the boardroom. And we don't know what the product is because it hadn't been released yet. And so their forecast was, look, it's really going to go really well or really, really badly. And as it turned out, it went really, really badly, but none of us had any idea at the time that the report was written whether that was going to be the right outcome or not. So I'm not interested in the final forecast or the final valuation. That's kind of the mechanicals that's applying the valuation models to the forecasts you get. But I am interested in hearing about what was your thinking in getting to those forecasts, and what do you think are the ones where you have the most or the least confidence in, and how important are those ones? And so that process will be, I guess, you'll be thinking about that in two ways. One, if I change the inputs a little bit, which inputs bounce the value about most? Secondly, what are you just the least confident about because it's either macro uncertainty, it's industry uncertainty, the new CEOs come in, or whatever it happens to be. So there's a whole range of ways that you can start thinking about setting up that sensitivity analysis. But I guess the key is don't shy away from that uncertainty. Often you kind of see reports where people are really overconfident. So look, here is exactly what is going to happen. Look, we don't know what's going to happen. It's but thinking about what's plausible and where's the uncertainty is going to be a really important part of it. And so that's kind of usually what distinguishes it, like a really good report from a not as really good report, is that level of, hey, reader, pay attention. Here are the bits you want to pay attention to. Here's my base case, but there's variation around that base case, and what does that variation look like?
Awesome.
What other questions have we got on our forecasting? What I put up on Moodle. So there's a couple of ways. Obviously, one of the things that you might want to look at is, once you come up with your forecast, I guess an obvious thing to have a look at is check. You kind of want to say, look, are my forecasts in line with what analysts are saying? And one way of doing that is looking at FactSet. What I don't want you to do is kind of match the analyst forecast in FactSet. You can kind of, in some cases, you can see some individual forecasts, but often it's just the consensus numbers. And again, there's variation there. And as we'll see later on in the term, it's the analysts are not always accurate with their forecasts. So again, I'm not going to be looking at your projects going, oh, you did a bad job because your forecast wasn't the same as the analyst. It's the have you convinced me so you've told me a story about the business, you've told me a story about the industry. Do your forecast make sense given that story? That's really the framework that I'm going to be looking at things through. So do the numbers make sense given the story? What people tend to try and do is force their forecast so that they get a value something close to the prevailing share price. Again, don't do that. You like a marking criteria isn't, can I match prevailing share price. Again, because that's just a mathematical exercise. An interesting way of kind of, I guess, flipping this sort of project would be to say, can I take current share price, come up with a set of forecasts that generate that share price, and then discuss whether those forecasts are plausible or not? That's kind of like a working backwards way of doing it. So, yeah, generating a set of forecasts that get the share price or really close to it is, as I said, that's just as you'll see next, it's just a straight mathematical exercise. It's not hard. It's very easy to do. You just change one or two inputs and you get that. So, as I said, sort of crafting the story, matching the story to do your numbers, and by do your forecast reflect what your story is telling me? So it's kind of by the time I get to the end of you, okay, I've read about your strategy, I've read about your industry analysis, read about what you think is going to happen. I've already got in mind, here's what I think are a plausible set of change in profits, change in sales, and so on. So to what extent do the numbers match up with that? What I've got in terms of some of the readings, for retail, we've got this type of paper that Asher Curtis and co-authors did. These types of papers and the kind of the forecasting earnings, kind of using a statistical technique, they tend to be more if we are trying to forecast large sample rather than one specific firm. So I might even just make a note here that that's exactly what people are trying to do here. So so there are, as I said, different types of models that people will use to try and forecast different components. So I guess one of the key things that they say in this paper is the kind of the key. So prior models that forecast firm level sales are based on estimated rates. Let me just make that a little bit larger so you can see that. Prior models that forecast firm level sales are based on estimated rates of mean reversion, and that's the sort of those charts that I was showing. And they show that by distinguishing between growth in new stores and comparable growth rates, they get more accurate forecasts. And again, this is talking about large samples. But I guess what it says for us is, if we're thinking about individual forecasts, really the takeaway here would be, think about, is there going to be differences in, I guess, the different segments or the different categories of sales that they're generating? So what they're saying here is, new stores. So is there a difference in new stores and comp stores? As I said, I didn't do that in my JB Hi-Fi forecast. And the reason being is that the number of new stores relative to the existing stores is kind of statistically rounding to zero. It's 1 out of 200 stores is a new store. So in terms of is this going to matter for my forecast? No, is the answer. But thinking more generally, that's one of the sorts of things that you want to think about. This Peter Easton paper, again, I don't expect you to kind of understand all of the statistics going on. What they're showing is that rather than forecasting sales, they're trying to forecast earnings. But what this paper really does is saying they use a particular statistical technique, and what they try and do is try and match earnings kind of patterns based on a whole bunch of other firms, and I don't care what industry they're in. If I've got a match of, like, if earnings growth or earnings decline, based on what's happened historically, what's the most likely next year's earnings number? And so this is kind of, I guess I threw this up just to give you a sense of this is far more of, I guess, a quant or big data driven approach to forecasting. So here they're not looking at how the sales are generated, whether the profit margins change or not. All they're doing is, are there statistical patterns that are likely to guide what's happening to our firm? That's kind of really what they're doing, and they kind of show you towards the back. They might show you an example of what they used to have some figures in here. Where are the figures going to be? So yeah, so this chart here, which is kind of showing what they're doing. So they're saying, here's the pattern of earnings kind of going up prior to kind of their estimation. Then they'll say, here, we will match that up with a whole bunch of firms that had similar looking patterns of earnings, and here's what happened the following year, so we'll take the median. So it's kind of just letting so it's a data matching process rather than what we're doing, which I guess we would call a fundamental analysis process. So this is kind of, sort of a strict quantitative analysis rather than the data. So quantitative analysis in terms of data matching and versus thinking carefully about what we think is going to happen to our particular firm. And the sensitivity stuff that I was talking about will come back, and I'll kind of show you how this can work. But the information that we've got here is, and I've got this the relevant spreadsheet up. What we're really doing here is setting up. I've got two different types, two sorts of sensitivity analysis that we're looking at. The first is, and I mean Moodle, not Teams. I haven't updated that, sorry. Is what this is showing here, this first one, is saying, look, I'm going to forecast demand. There's kind of four discrete outcomes here. So product could be 10, so it could be 10,000 units, 20,000 units, 40,000 units, 60,000 units, and I assign a probability to each of those outcomes. I'm then saying, taking those outcomes, how do I get rid of AI assistant button is kind of really annoying. So what we can do is model how that will work in terms of coming up with a kind of a random distribution, saying, so using the random number generator in Excel is effectively saying, okay, so give me a simulation that is conforming with this kind of what I've modeled out as the demand. As I said, that's a kind of giving you discrete outcomes. Probably the one that's more likely to be useful is this second one, which I've got. I thought let me just check that I've got the second one here. Oh no, that's a different spreadsheet. It's a similar, I'll check that document. I thought that I had more. What I've done in the other document, or in the actual spreadsheet, let me just show you what's in the spreadsheet. I'll save that. Let me just change the share. I'll come back to this when we're getting our valuation here. What I've got is a walkthrough of how we generate a simple random number. So this is just where we've got forecast demand and the probability. Then I said, look, here's what we want to do. If we just want to show it, so a different way of showing that kind of same sort of outcome will be to say, I've got a random number where the average or the mean is 40,000 and the standard deviation is 10,000. What would that look like if I want to do 500 trials of that? And so what you can see here is, using these formulas that I've got, is depending on what this random number is, sort of 0.9 will give us a high outcome, 0.01 will give us a low outcome, and so on. As I said, I'll go through this kind of in more detail and show you how this works. Where this can be useful is using this to try and say, okay, my final year sales growth might have an average value of 4%, but it could have a standard deviation of kind of 1.5% or 2%. And so when I kind of model out expected sales variation and expected profit margin variation, then I can end up with kind of here's my expected distribution. You get a sense of how that distribution works based on the range of, whatever you tell it as the range of inputs. So one thing that kind of, if you get a chance to have a look at that kind of that Monte Carlo forecasting, I've also got, and I'll just check that I've got that. I did pop up hoping that there is, oh, okay. Yeah, I have got a video that I will, in addition to what I've got there in terms of the document, I've also got a video walkthrough that I'll pop up and just link back to that in next week's material that kind of lets you kind of, in effect, steps you through it kind of cell by cell in terms of how to do that. If you kind of follow along, we can end up getting a kind of a Monte Carlo simulation relatively quickly, and certainly in not much more time than kind of just doing here's a base case, here's an optimistic, here's a pessimistic. The advantage is that it just gives you a bit more nuance in the type of sensitivity that you're actually forecasting, rather than kind of just 3 different observations. You get kind of the outcome range of observations. Yeah, so as I said, if you haven't had a look at that, have a look at that. I'll talk about that in more detail once we kind of see how our valuation models work, and then we want to think about what are going to be the appropriate variables that we want to subject that sensitivity analysis to. So end of next week, you've got the earnings call. I was asked about what sort of formatting requirements are on there, and the response was going to be make it professional rather than academic, was the broad response. So something that you would, like, if you wanted to summarize it and send to your team or your boss or whatever, in whatever style that is as appropriate. I'm not going to, but it doesn't need to be kind of like a formal academic piece in that sense. So something that's going to be more, here's how I do something as a report. So I'm interested in kind of your responses to the conference call, but I'm less concerned about obviously we've got either I gave you a word or a page limit, so make sure you just comply with that. But otherwise, I'm not fussed about kind of the specific formatting that you choose. As I just make it look professional. Any other questions on what we've got? So we've got that earnings so the earnings report next week. Then we've got a couple of weeks where we can kind of do the valuation part of the project. and then sort of subject that to some sensitivity. And then you want to kind of think whether, okay, so based on what we've come up with, do we think that your firm is a good or a bad investment opportunity? And part of that's going to be driven by what we think or what our considerations are with respect to market efficiency. So to what extent do we think it's likely that the market is wrong? If so, how long can it stay wrong? And sort of these sorts of considerations. So that's what we cover when we're thinking about kind of equity security analysis in a week or two. So valuation next week, then we think about multiples, then we think about equity and security analysis and credit analysis kind of in the final formal class. What I'll probably do, because then you've got a week or two before you need to get that project to me, I'll be happy either just to have an additional, if this time works, effectively have a consultation in week 11 if you've got any issues that are coming up with the project. Otherwise, I can kind of just, happy to jump on a Zoom or a Teams call kind of, whenever it's going to suit when issues come up. We're probably hopefully, if you're starting to work away on the forecast and getting soon to the valuation part of the project, you're probably likely to come up with more questions. Don't hesitate either. Shoot me an email. If we can solve it by email quickly, great. Otherwise, as I said, more than happy to jump on a quick call or a meeting, and we can, better to get these things resolved quickly than have them kind of, bugging you over time and leaving them to the last minute. As usual, I'm happy to stay on. Otherwise, so I said, for forecasting, sales, so the basic approach, sales, and how do we get the sales, both in terms of margins and in terms of the assets that we need to employ to generate the sales. And that's kind of like the two buckets that you want to think about. And if you're thinking about both of those buckets, then hopefully we end up with something that is kind of at least internally consistent as we go through that sales process. If you're pushing around that spreadsheet that I've popped up for JB Hi-Fi and anything that isn't clear on how I've done something or why, shoot me an email and I can kind of update with some explanations. And if I think it's useful just to do another video to help explain things, more than happy to do that, because that seems to be it's sometimes helpful if people could just see me going through things step by step. But otherwise, I will let you roll. Have a week. As I said, happy to stay on if people have got any specific questions.
I have questions regarding assignment 2.
Sure.
But more on the technical side. So I noticed for my company, the conference call divided into 2 parts. So the first part is when the company give presentation about their financial reports, etc. And then the second half, I think, of the conference call is where all the attendees can raise so much questions.
Yep.
So I actually stopped watching before the Q&A starts, because I thought by only paying attention to this first half, which the presentation itself can give me enough information to answer all of the questions. But after you mentioned, you usually stay because all of the analysts usually raise questions on the Q&A session. So that's why I think, like, should I continue watching until the end, or the first half would be enough for assignment 2?
Yeah, I've said, I'll bring up assignment 2 and show you to the extent that the questions, because I have said here, what are the issues raised by the security analyst? And so that's normally the part that comes up in the Q&A.
Okay, got it.
Yeah. So to the extent that analysts are raising some of those questions, and depending on, normally it's, for most companies, it'll be analysts will get to ask questions and sometimes investors, but normally the analysts go first. And so to the extent that the analysts are asking questions, then I think it'd be worth trying to summarize those.
All right, got it. Thank you, Jeff.
Yep, no problem.
Thank you, Fazile, for asking this. It was actually bugging me too. So it's good. Thank you.
Yeah. So is that making sense?
Yeah. No, all good.
Yeah. So as I said, the typical process is CEO will give a look. Here's what's happened to the business. CFO will talk in more detail about the financials. Then they'll kind of open up the conference to analysts, and so, okay, we'll get Sean Cousins from Barrenjoey, you've got the first question. Yeah, okay, I wanted to ask you about the margins in the Australian business. You said that they're under pressure or whatever it happens to be.
Yeah, no, good. Thank you. We'll be kicking off this week, so next week we'll be asking you more questions.
Yeah, exactly. So no, I'll make sure that I'm checking the email as that date gets closer. But yeah, but that's if that wasn't kind of clear, that's kind of what I was after there. So what yeah, as I said, for JB Hi-Fi, for example, it was really they were like the key issues that they were raising were margins on the Australian business was kind of the key focus. And also how they're planning on integrating that, the new business that they bought was kind of the second aspect of that.
Yeah, no, I think, the main question here was for me, what security analyst would be trying to achieve out of this call? So his concern is, are we lying or not? So this is
Yeah.
it,
Yeah.
essentially, yeah.
Yeah. And so, yeah, that's actually an interesting question. And what I should probably do is try and just dump up all of the remaining, sorry, let me just turn that off. The remaining week's materials, because I guess what analysts are trying to do, I guess, is a couple. So what analysts are going to do after these meetings is that they're going to send a note out to their clients saying, JB Hi-Fi had their recent earnings announcement. The earnings were X, the dividend is X. But the important part from the clients is, and here is what we think is going to happen in the future. And so what the analysts are trying to get a sense of is how can they improve their forecast, but probably also check with whether the story that they had in their mind about what's likely to happen to the business, do they need to update their story that they're going to tell the clients? And so for the JB Hi-Fi, one of the analysts was saying, oh, look, the sales in the Australian business were higher than we were expecting based on what our macro team was telling me about the headwinds that the consumers are facing, yada, yada. Why was that? Or software sales were lower. What was the cause for that? And so the analysts are really trying to update their story so that they can tell their clients or their customers something interesting. So it's, do I have an interesting story and can I update my own forecast? Because what the security analysts do is each month they will put out, look, here's an update for our JB Hi-Fi forecast. We've kind of revised our earnings estimate or lowered our earnings estimate. So that's part of what they do, but they also say, look, and here is how we think the company is going.
Sure. So, and one thing, for my understanding, security analysts are representatives of the ASIC or ASX.
Security analysts are typically going to be working for the two main types. So the analysts that are going to be providing forecasts that we see are going to be working for investment banks, so like your JP Morgan, your Macquarie's, and so on, or stockbroking firms would be the other one. Sorry, excuse me.
Okay.
Okay. And so what these analysts do, these are what we call sell-side analysts rather than buy-side analysts. So what so they're part of like the research team, the equities research team. So these analysts will put out analyst reports, as I said, they put them out monthly, or they'll update them if something important happens. And then these reports will go in the first instance to the big corporate clients of JP Morgan or Barrenjoey or whichever the firm. Then they get into the public domain. So if you've had a look at FactSet and you've had a look at the estimates part, that's what you will see summarized there. They get summarized in other commercial databases as well. So they'll come up on Bloomberg, they'll come up on various corporate databases that pay for those. But so in the first instance, they go to clients, then they go into the public domain. So they're different to buy-side analysts who do the same job in terms of analyzing businesses and coming up with forecasts. But the buy-side analysts will be working for actual traders, so superannuation or pension funds or the proprietary trading desk of banks or hedge funds or so on. And so the buy-side analysts, their research and their reports go to their boss who trades on their research. So it doesn't go out to the public and it doesn't go to customers. So we don't get access to the buy-side analysts. one of the concerns, and we talk about this later in the course, is to what extent do I think that the analysts' forecasts who we do get, to what extent are they likely to be biased so that they get access to better information from management because they're sort of telling the right story?
Mm-hmm.
But yeah, so in short, it's a combination of investment banks and stockbroking, or organizations that do trading for clients are really the two. So the concern is that you might be trying to get me to trade more by virtue of your report, or if you're a client, I might be trying to get in good with management so that I get the lucrative transaction business when you do your next capital raising or so on as the other concern. As I said, I can put up some notes that'll kind of get us through to the end of the term where you'll kind of see that covered. Oh, actually, that's already there in the equity security. That's right. We do have all of the full course book. Let me kind of I'll quickly show you what I'm talking about there in terms of course. Yeah, I'd forgotten that we actually do have, where's our course material? Let me click on that. It's that annoying ebook, isn't it? Where's the rest of the ebook? Is that just how to use the ebook?
Yeah, you need to open it, the whole thing.
Oh, yeah.
And you need to download the whole thing as well.
Yeah. Oh, yeah, I know. Drives me crazy.
It's okay. We can catch it up on next week. It's no
yeah.
I'll let other peers ask questions.
Okay, so it's what we've got down in Unit 9, Equity Security Analysis.
Yeah.
And really what I'm talking about is, so performance of fund managers. Oh, here we go, is security analysts is what I'm talking about. Yeah. So, yeah.
Ninth unit, yeah, okay.
Yep. Yeah, and so that's kind of really what...
Okay, I'll look into that quickly.
Yeah.
Cool. Thanks for that, Jeff.
No problem.
Have a good day.
Yep, you too.
Thanks, Jeff. Bye.
Hey, Cora. See you.